In this video, we'll be covering everything you need to know about UK cryptocurrency tax. All chapters will be timestamped below, and I recommend grabbing a pen and paper to make notes as we go through this topic because it does get quite complex. We're going to start off this video by laying down some definition and some ground rules, and I don't recommend you skip this part because it helps set the HMRC tone. But after this section, just feel free to skip to any part of the video that you want. So firstly, the $1 million question, or I should say £1 million question. What is cryptocurrency? Because that has a big effect on how HMRC view the tax rules. From a government point of view, cryptocurrency fits into a variety of categories, which makes it hard to badge into one set category itself. And this is why we see such confusion in the regulation space currently. Cryptocurrency technically isn't a form of currency such as the US dollar or British pound because it's not really recognized by a country and it's not really officially used as money. However, on the flip side, people do use cryptocurrency as a medium of exchange, which is technically the definition of money. Cryptocurrency itself is also different to your stocks and shares because technically there's no intrinsic value of buying a cryptocurrency. However, the value of cryptocurrency constantly goes up and down, which leaves it open for investment speculation, technically like a stock or share. So as we said, the question is, how do HMRC view cryptocurrency? Because that will affect the tax rules that we have to apply to your profit. Well, unfortunately, HMRC does not view cryptocurrency as currency, money, or a form of gambling. And that means any profits made of cryptocurrency is subject to tax because you lose a number of exemptions, which would normally be applicable to if you were dealing with currency, money, or gambling profits. Now, the reason cryptocurrency tax becomes a complex subject is because it's not taxed in one way. In fact, depending on how you make money in the cryptocurrency space will directly impact what tax rules we have to apply to that profit. It's not a one rule fits all when it comes to this stuff. So for example, there are a couple of ways we can make money in the cryptocurrency space, which we'll discuss in this video, along with the relevant tax rules that we need to use. So the first way is you buy cryptocurrency, let's say on an exchange, you hold it for a bit and then you sell it looking to make a profit. The second way is you help a network to continue to run and maintain itself. So for example, you help to mine cryptocurrency or you stake cryptocurrency in which you then receive a reward for those efforts. Number three, which is increasing in popularity, is you are given free cryptocurrency through airdrops. Number four is you can be paid in cryptocurrency, whether by an employer or you're just self-employed. The fifth way is through your decentralized finance activities. So for example, lending or borrowing, where you're earning an interest on that cryptocurrency. Now, this topic actually gets very complex itself and it would need its own video. So we're not going to cover this portion in the video because the truth is it's not going to apply to 90% of viewers. But if you do want a follow-up video, let me know in the comments. Within this video, you will find examples on how to calculate your taxable position. Once you have that taxable position, it is then on you, the individual, to apply a tax rate to that taxable position. And that tax rate will vary depending whether you're a basic rate taxpayer, a higher rate taxpayer, or an additional rate taxpayer. At the end of this video, I will include a quick summary of these different tax bands to help you try figure out where you sit on that scale. But trying to understand tax bands itself, again, is its own video because it's like an introduction to tax as a general subject. But I'll try my best just to give a quick 5 to 10 minute explanation on what tax bands are. And finally, before we jump into this video, I want to disclaim that currently there are no specific UK tax cryptocurrency rules, surprisingly. Now, of course, there is guidance currently available by HMRC, but the way that it works at the moment is HMRC are using pre-existing tax rules and applying that to the cryptocurrency space. And again, that's what makes this subject much more complicated because we're using rules that aren't developed for cryptocurrency and applying them to cryptocurrency. So as a result, I want to say that you should always seek professional advice of a chartered tax advisor. In addition, when submitting returns to HMRC, you should always disclose every single assumption you've made to provide full transparency. To confirm, I'm not a chartered tax advisor. As a result, this video is for educational purposes rather than professional tax advice. Scenario 1. Buying and selling. Whenever you dispose of a cryptocurrency asset for a profit, this generates a tax charge. Now, disposing of your cryptocurrency asset doesn't mean selling it for a normal currency, so selling your Bitcoin for US dollars or British pounds. Disposal of cryptocurrency cryptocurrency asset is defined as whenever you no longer hold that original asset. So for example, if you convert from Bitcoin to Ethereum, you have disposed of your Bitcoin and that leads to a tax charge. In addition to a cryptocurrency charge being applicable when you swap from asset A to asset B, a charge is also applicable if you donate your cryptocurrency and if you use your cryptocurrency to buy something. So let's say you purchase coffee with your cryptocurrency. In the eyes of HMRC, all three of these transactions result in a capital gains charge. Now, I'm going to caveat this because technically, if you are a professional trader, so you're trading cryptocurrency on large scales, professional organization, and this is your main form of income, then technically these charges will fall under income tax and you would have to skip to scenario 4. However, for 99% of people watching this video, the transactions you make are more likely going to fall into this scenario 1 of capital gains charges. My assumption would be if you did fall into scenario 4 of being a professional trader, you would most likely have your own tax advisor anyway, and you wouldn't be relying on YouTube to understand how to pay your tax. In general, gains of cryptocurrency, so the profits you make, are treated the same way we treat shares. So every single asset you hold will have its own tax charge. So let's run through an example so you can see with your own eyes on how this all works. Raj bought 2 Ethereum for $3,000 in January. Raj then changed his mind and decided Bitcoin would give him a better return on investment. So he exchanged his 2 Ethereum for 0.2 Bitcoin in March. The market value of the 2 Ethereum was $9,000 during this swap. As we said, exchanging one type of cryptocurrency for another results in a disposable charge. To work out the tax position, Raj needs to convert the US dollar amount into GBP on the relevant dates and calculate the tax gain. Again, these numbers are made up to make the calculation easier. Now in January, the exchange rate was 0.8. As a result, our $3,000 translates to £2,400. In March, the exchange rate was 0.7. As a result, our $9,000 sale translates to £6,300. Raj has a gain of £6,300 minus £2,400, which equals £3,900. Therefore, this is the balance which is subject to tax. Everyone has an annual capital gains tax-free allowance, which is £12,300 in the 2022 to 2023 tax year and £6,000 in the 2023 to 2024 tax year. So if this was the only trade Raj made in the 2023 to 2024 tax year, then he would pay no capital gains tax and have a leftover balance of £2,100 still to use. If Raj exceeds his annual capital gains tax-free allowance, then his profit is taxed at 10% if he is a basic rate taxpayer, or 20% if he is a higher or additional rate taxpayer. Now, sometimes you can find yourself making a loss. Any capital losses can be offset against other capital gains. Let's say you made a loss on trading Bitcoin but made a gain trading Ethereum. The loss in Bitcoin can be offset against the gains in Ethereum. If you made a total loss in the tax year, so every single trade you did just ended up losing money, you can carry that loss forward into future tax years and offset that loss against future tax year gains. But to do this, you need to make sure you've disclosed your losses to HMRC in the year that it happens. You cannot offset capital gain losses against your income tax, however. It's only like for like, capital gains for capital gains. If you lose your cryptocurrency, so let's say, I don't know, you lost the keys to your wallet or you were rugged, then HMRC does not consider this as a disposal of assets because technically you still own the underlying assets even though they were stolen from you. This is technically not a disposal and doesn't lead to a tax charge. However, given that there is no tax charge, you can also not claim a tax loss for losing your cryptocurrency. I'm going to caveat that statement again, and you might find that a lot in this video because again, tax is a complex subject. But technically you can make a negligible claim value claim to HMRC. This is where you have to demonstrate to HMRC that there is no realistic possibility you can regain access to that cryptocurrency. If this argument is accepted by HMRC, you can then apply a capital gains loss for the cryptocurrency that you lost. But I'm not going to cover that in this video. Scenario 2, mining and staking. HMRC say that income from mining or staking can be treated 2 possible ways. Number 1 as trading income, or number 2 as miscellaneous income. In reality, most of you watching this video will fall under the miscellaneous income tax charges. To be taxed under trading income, you need to meet a set of criteria which we call the badges of trade, which in short requires you to be mining or staking on such a large scale operation that essentially this income is enough to live on or run a business on. So in scenario 2, we're gonna follow the miscellaneous income route, because again, that is what is going to be applicable to most of you watching this video. Now, if your income is below £1,000, you do not need to declare that to HMRC. If your income is above £1,000, then a tax charge will be generated and will need to be reported to HMRC. So I'm going to run through 2 examples here on how to calculate your tax profit. Example 1, Ravi earns $3,000 of Ethereum from staking in January. This needs to be converted to GBP on the day you receive the income. So assuming a 0.7 exchange rate, Ravi made £2,100. Ravi can elect to use his £1,000 allowance, giving him a taxable profit of £1,100. Example 2, Simran earns $10,000 off Ethereum from staking in February. Again, we need to convert it to GBP, so let's assume an exchange rate of 0.8, which gives us £8,000. In Simran's scenario, she actually spent £1,000 on electricity running her computer and hypothetically paid £1,000 for a certain piece of hardware to perform her staking activities. As a result, Simran gives up her £1,000 allowance and instead chooses to offset her allowable expenses against her income. This would result in a taxable profit of £8,000 minus £1,000 minus £1,000 equaling £6,000. For a full list of allowable expenses, you need to browse HMRC's website to see what is allowed and what is not allowed. This profit is then treated under income tax, so 20% if a basic rate taxpayer, 40% if a higher rate taxpayer, and 45% if an additional tax rate payer. Scenario 3, airdrops. So there are 2 main ways you can receive an airdrop. Number 1, you receive an airdrop for free, you do absolutely nothing, and you're just airdropped some form of cryptocurrency. Number 2 is you receive cryptocurrency in the form of an airdrop for performing a certain type of service. So let's say you did some marketing material on Twitter and you received some cryptocurrency which was airdropped to you as a form of payment. So again, depending on how you receive that airdrop will depend on what type of tax charge is applicable. If you receive an airdrop for performing a service, this is treated as a miscellaneous income. As a result, you need to pay income tax on that balance. If this is the case, please watch scenario 2, mining and staking, because it follows the same process and logic. You can reuse the examples that we talked in scenario 2 to calculate your tax position and therefore the tax payable. If you receive an airdrop for doing absolutely nothing, then you need to pay capital gains tax. When receiving an airdrop for free, tax is only chargeable once you dispose of that asset. So if you fall into this bucket, please watch scenario 1, because again, it is the same logic and same process. You can reuse the examples from scenario 1 and apply it to this scenario. Scenario 4, employment income. Now the chances of you falling into this scenario, I would assume is pretty rare. So we're not going to run through any example calculations for scenario 4, but we will cover the basic situation so you do have a basic understanding on what you would need to do. We'll run through 2 levels of understanding. So what you would do if you were employed and paid in cryptocurrency, and what you would do if you were self-employed and therefore paying yourself in cryptocurrency. Now, if your employer pays you in cryptocurrency and that cryptocurrency can be easily converted in cash, then your employer needs to account for income tax and national insurance on the value of that cryptocurrency. Usually they will just deduct this from your wages itself directly, or you might have to reimburse them separately once you're provided that cryptocurrency. If your cryptocurrency can't easily be converted to cash, then usually you don't need to pay employee national insurance on that balance. But again, your employer will still deduct some form of tax through PAYE. If your employer has not deducted any tax through PAYE, and in addition, if HMRC have not adjusted your tax code to try reclaim that tax, then you may find yourself having to pay HMRC directly through self-assessment to pay the tax that you owe. But again, I'd like to hope if you are being employed and paid in cryptocurrency, your company would have some sort of HR department or payroll service which you can talk to about this. If you are a self-employed trader, so you're buying and selling cryptocurrency, as we've discussed many times in this video, HMRC really do try to classify that tax as capital gains tax. But if you are making large scale trades, it's in an organized manner, a professional manner, a degree of sophistication, then the chances are you will fall under trading income, so self-assessment. That would result in you having to pay national insurance and income tax rather than capital gains tax. Note that just because you are buying and selling cryptocurrency doesn't mean you're automatically a self-employed trader. Technically, you need to meet this criteria called badges of trade to fall under this topic. And I'll leave a link in the description to HMRC's page so you can see what counts as the badges of trade criteria. UK tax bandings. So what are UK tax bands? Well, in the UK, we pay different levels of tax depending on how much we earn. So generally, we have three categories: basic band, higher band, and additional band. Income within each of these bands is taxed at a different rate. So how do we know which band we fall into? Well, this table summarizes it best. This is how you determine which band you fall into while excluding the allowances we've talked about. You can then apply this to the scenario examples we've talked about to determine what your tax payment should be based on your own personal circumstances. I hope you enjoyed this video and I hope you learned something new. If there's anything else you'd like me to cover, make sure you let me know in the comments. And as always, make sure you like and subscribe.